Atif, I guess you're gonna speak more about that after these two presentations.
Thanks, Pierre, for for having me. I will talk about finance or financial policy and inequality. You know, we have all, I believe, heard this story of a frog who's sitting on a pot of water which is slowly boiling, slowly heating up, and the frog never realizes that the water is actually getting warmer and warmer until it's too late, and you know, the frog cannot jump out of the water. What this story tells us is that sometimes it's these slow moving forces, the gradual but persistent forces that we may not perceive on a day-to-day basis. It is actually those forces that are the most important. And so I would like us to keep this analogy of the frog in mind when we talk about finance and inequality or financial policy and inequality. And what I'm going to talk about is I'll try to emphasize that actually inequality, and when I say inequality, I don't mean inequality in a general sense of the word. I mean inequality very specifically in the sense of extreme inequality, which is the share of income or wealth, as Ratna was emphasizing, going to the top 1%. It's really the top 1% that matters, by the way, in terms of what the stuff that I'm going to talk about. But again, coming back to the frog analogy, what the core point I'm going to say here is that inequality actually is of first order importance and is one of the most important factors right now, if not the factor right now, that is relevant for understanding financial markets, financial policy, as well as economic growth. This is a bit of a strong claim, if you will, because that's not how we traditionally think about either finance or macro. And so that's why I'm going to spend a bit of time explaining why that is the case. It's sort of a bold statement, but I've increasingly come to believe in this strong statement given the work that I've done recently. And just for those who are interested in digging deeper into this question, I will refer them to the recent work that I've done with Amir Sufi and Ludwig Straub at Chicago and Harvard, respectively, a couple of papers, Intended Demand and Savings Glut of the Rich. Those have the main points that I'm going to touch upon. So what's the connection between inequality and finance? What is this rising temperature that we have not been fully internalizing that we should have for a while now? Well, the first point, I'm going to make two sort of conceptual points here. And the first one really is that finance is not what we think it is at some level. What do I mean by that? Well, if you went back to your standard textbook model of finance, what are we taught about what finance does? What we are taught about what finance does is that there are savers who try to save, and then there are entrepreneurs who get that saving through the financial sector, and then they invest, and everyone lives happily ever after, right? That's sort of the typical finance story. There's nothing wrong with it. It's not that I'm saying the story is wrong. It's exactly right. This happens. But this story is incomplete in a very important way, and this is where I'm going to connect finance with inequality. The reason this particular story is wrong is that while the financial sector does what this story tells us it does, at the margin, the big growth in finance since the 1980s, by and large, has nothing to do with the story. So if we want to understand the change in finance, if we want to understand the change in financial sector, by and large, this particular story is not really an accurate description of finance. And one very simple way of understanding it is, if you go from 1980 to today, we know investment to GDP has not gone up at all. In fact, if anything, it has slightly trended downwards. And yet, all of us know financial sector as a share of GDP has more than doubled, and even more in some countries. So what is going on? What is this huge expansion in finance doing since the 1980s? That's where the traditional story is no longer valid. So what is actually going on? So this is where we investigated a bit more carefully. And the bottom line is that by and large, this expansion in finance is explained by rising inequality on one side, which is sort of the supply of credit, if you will. And then it's actually very straightforward to explain why. We know that the very rich, the top 1%, have very high propensity to save out of permanent or lifetime income. And so as the share of income going to them rises higher and higher, naturally what happens is the supply of savings, which is the same thing as the supply of credit to the economy, is going to rise higher and higher as a share of the pie, the GDP. Now, if this rise in saving were to be absorbed as higher investment, just like our traditional textbook story tells us, everything would be hunky-dory and we would live happily ever after. The problem is, as I've already said, investment has not risen. So where is all this money going? And when you look at it, this money is primarily going in what is you can classify as financialization of the economy, which is levering up of existing assets. Another way to say the same thing, because the economy is an ecosystem and things have to balance, supply has to equal demand, both on the good side as well as on the credit side. It's the bottom 90% that has been borrowing more and more or dissaving more and more. Both processes have been going on. It's the bottom 90% that has been borrowing or dissaving more and more to absorb the savings, the increased savings of the top 1%. This is what we refer to as the saving glut of the rich. That's in fact the title of one of the papers that I was referencing earlier. And this process of rising inequality in the presence of stagnant investment and hence increasing financialization of the economy is the core problem we are facing right now. And let me just quickly come to COVID. What COVID has done, and both the speakers before me exactly have emphasized this as well. The one unique factor about COVID is that it is the most unequal recession we have seen in modern era. Not just the depth of the recession, but it's the most unequal. By and large, people, including people like everyone on this panel, we are the Zoom economy, right? We have not been affected as much. All the pain is really at the bottom. So COVID is hitting exactly at the fracture which has been deepening over time, and that's why it's so serious. And this process is unsustainable. That's the core thing, and I'll come to macroprudential and so on. But this is really the core. Again, that's why I said it's the frog analogy. We're all going to boil here if you don't pay attention to it. Let me say a few things on the macroprudential side. And again, I'm going to say something which perhaps may sound a bit extreme, but I think that's right. Macroprudential is obviously important. All the usual that one should not overextend, leverage ratios, and so on. They're all important. But while they are important in the usual sense of the word, they are not relevant anymore. That's an important distinction. Why do I say they are not relevant anymore? Let me make an analogy to kind of explain that point a little bit more. The reason they are not relevant anymore is in the same sense that monetary policy is not relevant anymore. That's not to say monetary policy is not important. You can do silly stuff with monetary policy. So you want to avoid mistakes. In the same way, you want to avoid mistakes on the macroprudential side. But monetary policy is irrelevant, as all of us know. That's not a controversial point because it's not effective anymore. It's not relevant anymore. It's not the force that really can change things on the margin. So exactly in that sense of monetary policy not being relevant anymore, macroprudential policy is also not relevant anymore, precisely because of the important role of inequality in finance. So let me explain that a bit more. Keep in the background the context of water getting hotter, which is this rising inequality and saving glut of the rich. In that macro framework, if you try to lean against rising credit, what's going to happen? If you don't change the structural force and you have this saving glut of the rich, if you lean against that through macro-proof, monetary policy, whatever tool you may end up using, no matter which tool you use, you're going to force the economy into a recession. That's what I mean by monetary and macroprudential is no longer relevant, because the structural force is too strong. And if you try to lean against that, you will get embedded into a liquidity trap, because there'll be too much savings at the very top, and you're preventing those savings from going anywhere in the real economy through consumption, through borrowed capital and consumption. And so it's in that sense that macroprudential policy has become irrelevant. So let me now just close by again going back to, we need to understand that we are boiling in this water, which is the heat is inequality. It's become unsustainable. Let me just give one telltale sign of unsustainability, which is the long run interest rate, sometimes R star as it is called in technical lingo. It is precisely because of this heat that I emphasized in the beginning that R star or long run interest rate has been trending down from 1980 and has gone all the way down in negative territory in real terms. That's the sufficient statistic that tells us everything we need to know in a way. And one way to think of are we doing the right thing is to talk about policies that will get R star to move in a positive direction. And the problem with the status quo is that if you binge on more credit, that pushes R star further down. This is the point we make in this paper. We call indebted demand. So the technical aspects, I'll refer the audience to that paper. But the intuition is actually extremely straightforward. If the solution to problem is more debt, one consequence of that is that the interest rate cannot move higher anymore because now you have even more debt. And if interest rate were to rise, the debt service burden of existing debt will be so large that everyone will kind of go underwater. So this is sort of the mega or the meta macroprudential point. It's not the usual macroprudential point. It's the general equilibrium macroprudential point. And we need to internalize all of these forces. This is the water that is going to boil all of us. We need to internalize all of these forces. So I'm going to just end on this important point, and COVID has just brought this point home for the reasons I already mentioned. We cannot ignore the consequences of this extreme global inequality that we have. It has to be addressed. The core thing is 2 points on the policy side. The first one is public investment in areas where the returns to those investment disproportionately go to the bottom 90%. We can talk about what that means, but that's key. Public investment has to rise. And I mean investment, I don't mean transfers. Public investment has to rise. Number 2, we need redistributive policies. And that means both things, by the way. It means lowering of tax burden on the bottom 90%, direct and indirect, like payroll would be one example in the US. And then raising taxes, which includes inheritance taxes, estate taxes. So not just talking about income taxes. And we need to think very seriously about wealth taxes and think of practical ways of implementing that at the very top end. Again, it's a very serious problem, and I think we need sort of a realization of the extent of the problem and deal with it head on. Thank you very much.